So today we're going to do a video about Hims and Hers. It was very close between if I do a video on Hims and Hers and PayPal. They're both very interesting for me to do a video on. So I thought, you know what, we'll go with Hims and Hers because we do normally do a video of their earnings on the YouTube channel. So we'll go with Hims and Hers today. And I thought we'll go through the earnings and break them down together and give my opinion on Hims and Hers stock. So obviously, yeah, a stock that I've owned. I've only stocked for around about a year and a half now. It's been a very good performer, a stock that I've been up over 100% on. And we'll go through their earnings. So first of all, let's just talk about the share price, because obviously, as we look at the share price, the stock was down nearly, when I was checking, it was nearly down 10% today. So you're looking at that and going, oh, these must have been really bad earnings. But actually, when you dig into their earnings, they were very, very solid again. And I'm struggling actually to find a reason why the share price is down 10% today, because these were absolutely amazing earnings. Once again, we've expected to have really good earnings from this company. It's kind of come the norm now, but when you actually look at how good and how big they're beating these earnings and upgrading the guidance as well, it's scary how well they're performing. And it's one of those where you're looking today and like, why is the stock down 10%? Now for me personally, when companies actually bring out earnings, I always try and avoid the share price before I read the earnings. The reason why is because when I go into the earnings, I want to have a neutral view. I don't want to be persuaded about a share price going up to see if it's a better earnings than the share price maybe influences me to think it's a better earnings than what actually is there. Or maybe the share price is down and I already go in with like, oh, this is really bad earnings. And then I read it and I'm a bit more biased to a bad earnings. I always like going in at a neutral point of view, and I saw these earnings and I was like, wow, they're another great set of earnings. And I was expecting to see this stock up probably 5-10% today off these earnings, and then it's down. So absolutely crazy. But this is what happens in the stock market sometimes, and it's, you don't really believe it until you see it, but sometimes the share prices do not follow the fundamentals of the company. You know, you only have to look at Hims and Hers. Hims and Hers was a stock that under 12 months ago you could have picked up for $3, and that stock went up to $12. That was in a year. In a year, the stock market has decided the stock could be worth down at $3 and it can be worth up to $12. You know, 4x the return. And that's a massive range on a company, and that's in a year. And that shows you how brutal and disconnected the stock and the stock price can be from the company. The company hasn't changed that much in a year. You look at the fundamentals of the company, there's been no change to justify it being $3 and then go up to the $12. So either at one point it was incredibly low or it's gone incredibly high. And in my opinion, it was incredibly low. And with the drop today at 10%, it's not enough to get me to buy, even though I said that I'm really happy with these earnings. I would like it to go into the $6-7 range if I were to buy, which I don't know if we'll see that happen again. But like we said, at some point in this year, we were at $3. So nothing's impossible, but that's where I'd want to buy. But yeah, I looked at these earnings and I was like, there's a disconnect here. These earnings should have probably gone up on the share price, and they're down today. But that's one thing that I like to do on the share price point of view. Now, breaking down some of these earnings here. First of all, wholesale. So I've gone for the negatives first to start with. Wholesale was down 9%. Now, there's 2 points to this here. Wholesale isn't a major part of the business, so it's not a major impact on it. And one of the big things about wholesale is getting your brand in something like a Target, for example, and people getting aware of your brands. And it's kind of like free marketing and recognition here. So it's not a major part of the platform, but it's good to see it kind of building up. Now, it was down 9%, so I would probably like to see that a bit better, but that actually swung to a positive because of the wholesale going down so much, that probably actually helped the gross margins, which we'll talk about in a second. So it wasn't a major negative at all. That's me being quite picky. The one negative that I did see is that stock-based compensation went to 14 million from 8 million. Thought that was quite a steep increase. You know, you're nearly talking a double up on there. Now, the thing is, I've got to say is like, stock-based compensation gets viewed really negatively. Ever since like everything money came on the scene, it's been made to be a negative thing. And it can be a negative thing if you're getting diluted like crazy as a shareholder. It's not a good thing. But something like this, when you've got 14 million stock-based compensation and you've had a company that is been executing like this, do you really mind? Do you really mind when a company has just delivered 88% year-over-year growth, you're adjusted EBITDA profitable, that adjusted EBITDA is ramping up? If they're executing, do you not want to reward the staff there if they're doing these sort of rates of growth? Surely this outweighs the stock-based compensation, and surely you're happy to have stock-based compensation if they're bringing out these financials. So Yeah, I put that as a little bit of a negative, but it's not. Sometimes it's made out to be a bit more of a negative than what it actually is, but I put that down there. Now onto the positive. So EPS in line, that was good. We want to make sure the EPS is good. Negative 0.05. Revenue, this was really good. Up 88% year over year. So they are still keeping up with the 80% revenue growth rates, which is scarily good. So that was fantastic. And to put that into context, they beat by 11 million. That's a major beat on the revenue side of it. So not costing anything on EPS. The EPS is moving up in the right direction. And also the revenue growth is insanely good once again. 2023 revenue. So they hiked this up massively. So they hiked the revenue up from 830 million compared to 755 million. They hiked up their revenue that much. That is a major hike up. To hike up your revenue by that much is so impressive. And that's why some of the jumps should have just come up automatically. You know, a lot of what's priced in now, or what's happening now, is priced into the stock. You're looking at what's the stock going to say in the future? What are you going to be doing in the future that we can value off? And if in the future we're going to say, actually, you know those numbers that you're writing in, we're going to be higher than them. This is big thing. Guidance normally moves the stock. What the company's done right now doesn't really matter because it's done. It's out. Everyone's looking to the future. And when you're saying in the future you're going to be making this much more revenue, you should be rewarded for it. Adjusted EBITDA as well. That went up from 25 to 30 million, from 20 million to 25 million. Same again. You're doing it, you know, if you're going from the low side here, that's nearly a 20% rise in the adjusted EBITDA as well. This is impressive as well. So when we talk about the adjusted EBITDA and revenue being hiked up that much, this is why the stock should have been up today, and it wasn't, which is just is scary why it isn't up. It looks like some shorts or manipulation that's going on it there. So yeah, honestly, that's absolutely fantastic. Average order volume keeps rising up, so they're acquiring customers, and then the customers they have are ordering more on the website. That's always what you want to see. That's a good number to keep an eye on. Gross margins. So the gross margins went from 74% a year ago up to 80%. Now this could have been the reason why. They did say that the gross margins will go back down to the more historic 70% range, but I don't know. You know, Hims and Hers, we know they like to sandbag. They sandbag the guidance normally and then come into the year, and obviously when they get into the year, hike it up as the year goes on. I mean, even this year, I can't remember what the midpoint is on the guidance now. I think it's like 50-something% growth. I mean, realistically, we could see another year where this company's putting over 80% revenue growth in, so there's plenty of room for them to hike up from that point of view as well. But you know, gross margins, say it's going to go down to the 70% range. We'll see what happens, but that was so impressive. That's another reason why the shares should have gone up. If you look at the EBITDA from a year ago, it was negative 6.1 million up to 6.1 million positive, so that was a really good increase there. Net loss went from negative 16.3 million down to 10 million, so we talk about this, you know, they're not burning through the cash, the EBITDA positive now. The losses are coming down, and hopefully we see that move into profitability more and more as we go on. I've got to say, if they've done 6.1 million in EBITDA and their guidance was 20 to 25 million, you know, even if you just if it doesn't increase from here, if it stays at, you know, if you multiply that by 4, you know, obviously you're in the, you know, 24.3 million, which is in that higher side of it. And I would expect as the year goes on, that EBITDA is pushing up more and more as the year goes on, and you might be into double figures by the end of the year. So once again, the revenue guidance is sandbagged even still now. If they're going to grow 88% a year still, if they're going to carry on growing that EBITDA from here, that the EBITDA guidance is still sandbagged, which is obviously even more upside potentially further down the line. They talked about a lot of new products. I won't go through them all here. If you want to see the new products, you know, listen to the conference call, go through the presentation slide. On to the conference call. So Yemi actually took the conference call. The reason why Andrew Dunham was on maternity leave, he did leave a recorded message that was played on it, but he answered a lot of the questions. I thought he did a very good job. I always like having Andrew Dunham there because obviously with the co-founder, I think sometimes when you're the CFO, you don't want to step a bit too much out of line and maybe say things that you shouldn't say. And then, you know, later down the line, Andrew Dunham goes, "Why didn't you say that?" So yeah, I thought he did a very good job, but I always like Andrew Dunham there because he makes it sound like, yeah, he always goes back to like how, you know, quick they're developing and how rapid they are. He's a very good talker as well as a good founder. There was a question on EBITDA, so they were saying like the forecast wasn't hyped up as much as what they potentially could do. I think overall that was just sandbagging guidance, but once again, you know, maybe the terminology of like, oh, just to let you know that's conservative, just because of the macro environment they're in. Maybe that could have been said there, but I think maybe that potentially what caused maybe the drop. I always say, like, if you are trying to guess what caused the drop in the actual quarter in their earnings, then it's normally a sign it probably shouldn't have dropped. So that's where we're at. We're trying to work out why Wall Street didn't like it, and like I said, I'm a bit suspicious of what's going on today with that share price. Maybe it was the EBITDA guidance, but I can't complain when you've hiked it up 20%. It's still absolutely amazing. They got questions around the 2025 guidance. So if you guys remember, in Q4 they set out 2025 guidance for a bit of a long-term target, which is 1 billion revenue and 100 million in EBITDA. Now, they said, or the analyst was like, you know, what's the long-term vision on that? Is that still there? And Yemi actually said, and this is obviously this is kind of getting into his element a little bit as well, and these are the questions that suited him a bit more, is he said like the 2025 target should be seen more as a floor rather than a ceiling. Now we know that we've spent so long already today talking about them sandbagging guidance and how, you know, they're making sure they're being very conservative, and we probably knew that was conservative, but that was good to see that even in 2025, we're talking about 1 billion in revenue being conservative and 100 million in EBITDA being conservative as well. So that was really positive to see. Maybe we see that hiked up at some point in the start of 2024, maybe. And the last thing was, I felt like there was actually a lack of good questions on the conference call. The analysts were not really digging in much into the business, what was going on. So normally I walk away with a lot of and I don't know, once again, if this was Andrew Dunham missing and he would drop the right amount of details in for the questions. But I didn't walk away with too much new information this time round. And I think partly down to the analyst questions and also to Andrew Dunham not being there. And also, the Q&A session was a little bit short as well. I think it was about 40 minutes long. Normally, the Q&A sessions, you know, you talk pushing up towards an hour-ish. So a little bit short on the question side of it. But it's not the company's fault overall, but I thought I'd just note that down there. So anyway, that was Hims and Hers earnings. Overall, I thought it was another really good quarter, especially when you're hiking up your guidance this much. You should be rewarded for it, and yet you were punished on it, which is just absolutely insane. So yeah, I thought these were solid 10 out of 10 earnings once again. Even though it's down, I don't want to buy because I would like it a little bit lower, but for me as a long-term shareholder in Hims, I'm not worried. You know, this is one of those where it's, you know, short-term fluctuations, which are just absolutely stupid. You know, one of those ones where it was stupid, it got down to $3. It's one of those where it's stupid, it's having a 10% drop off these earnings. And my thing would be, in the long term, I still have very much confidence that it won't be too long until we see this company hitting $15, pushing up to $20 in my opinion. So yeah, I'm not worried at all after these earnings. Fantastic earnings. Crazy drop in the share price today. It shouldn't have dropped anyway. So yeah, that's my opinion. Anyway guys, hope you enjoyed it. Let me know what you thought of Hims and Hers earnings, and I'll catch you in a bit.